This video is how the pandemic changed money creation. We want to get this in a couple easy steps, so let's just dive right in. Pre-2020, money was created by the commercial banks. Right here we have all their balance sheets. You have the average Joe's balance sheet, the commercial bank's balance sheet, and the Federal Reserve's balance sheet. On one side you have their assets, the other side they have liabilities. Now let's break this down. The average Joe, his balance sheet, his assets is cash. His liabilities are loans. The commercial bank's balance sheet, their liabilities are the cash that is deposited by the average Joe, and their assets are the loans that are created and extended to the average Joes and Janes. Now we go up to the Federal Reserve. Their liability is the reserves. And we will get into this in just a minute. Their assets on their side can be mortgage-backed securities, treasuries, and government debt. Now, how is money actually created? Money is actually created before 2020. Money was actually created when the commercial banking system, or any bank in the real economy, made a loan to the average Joe. That money was created out of thin air. The average Joe had the cash in his asset side. He had to pay back the loan, which was his liability. And as he paid back the debt, that money was destroyed. Therefore, keeping the money supply in check, if they wanted to make more loans, if they seen the economy was going to heat up, there was room for growth, they could make more loans, increase the money supply, and then as the average Joe's paid it back, it was destroyed. So it balanced itself out. Where does the Federal Reserve come into this? The commercial bank takes the cash and they deposit it with the Federal Reserve, and that becomes a reserve, a bank reserve. Those bank reserves, prior to around 2008, they made it to where they could get interest on excess reserves. And we had a 10-to-1 ratio for reserve requirements. In other words, if the bank got in $100, they could loan out $1,000 off of that 100. They only had to have 10% of what they had on their liabilities had to be assets. So they could take $100. You could deposit $100 in your savings account. They could turn that into a reserve that was worth $100, then turn around and loan out $1,000 worth of cash and still be considered solvent, which is just a big term for we can pay our bills and we can survive another day. Well, what changed? In 2020, we got the CARES Act. Now, the CARES Act, actually, we get government spending before. We've built bridges, we've done things with, the government has paid for things, and it's no great big deal. We don't see a whole lot of inflation. The money supply doesn't go up tremendously because it doesn't go to average Joe and Jane's bank account. See, when the Federal Reserve and the banking system creates it, they also control how much lending goes from their loan side down to your cash side. So they can also say, okay, well, we're getting too much inflation or too much, we're getting either too much inflation, there's too much money flowing around. So let's dial this back a little bit. Let's make our loan standards a little more stringent, where people can't get as much money. Therefore, as the loans get paid back, it destroys it and brings the money supply back down into check. Now, thanks to the CARES Act in 2020, the U.S. government decided to skip the commercial banking system. We got the government enacting the bill. We got the Federal Reserve monetizing it in the form of bank reserves and treasuries. And it got deposited straight in to the cash side, or the asset side of the average Joe and Jane. Well, what does this actually do? This inflates the money supply. because it wasn't created as a result of a loan that was issued by the commercial bank. So these guys would have issued a loan, and then as the loans got paid back, they could have kept it in check by not issuing more loans or not issuing as many loans. And they could do this by saying you need a higher credit score to get another loan. But when these guys do it, it's just raining money. It comes down from government spending, the Federal Reserve, straight into the bank accounts. And why did I put this here? It had to stop at the Federal Reserve and not just come straight down into average Joe and Jane's bank account. Because if average Joe took his cash, his check that the government gives him, he goes and puts it in his bank account, say he banks with the Bank of America, when he puts all that cash in here and there's no asset to back it up, there's no loan, there's no extra mortgage-backed securities, they didn't create any extra assets to back it up to keep them from being insolvent and not able to pay their bills and not able to show that they had an equal amount of loans and cash. The Federal Reserve had to issue bank reserves for them to put on their asset side in order to keep everything running smoothly. So now we've got this hybrid system, and you can see it in the stock market. Let them talk about stimulus. Go back and watch the stock market on the days that they were talking about passing more stimulus after the CARES Act, and it would just go up, up, up. And then when it seemed they weren't going to get no more stimulus, it started coming back down. The market's like this. But what happens? Inflation runs rampant. And there's no way to really turn it off. Thanks to the way banking has changed, used to you got a decent return on your checking account. They give you something, 2-3%. If the Fed funds rate was 5%, they may give you 3%. If the Fed funds rate went to 8%, the banks had to compete for your money. Well, now we have free checking accounts, and they also don't pay any interest for parking your money at the bank. So these guys are getting free funds, so to say. So if they actually raise rates to try to pull the money in, which is another way of decreasing the money supply, is you raise rate. Interest is your price of money. When you borrow money, they say we want a 5% interest rate. They're saying we'll issue you the principal that you asked for, but you have to pay us 5% more than that back. That is the price of money. That is the most important price in a free economy, is the price of money. Everything hinges on that interest rate. Because at the end of the day, whether or not your entrepreneurs are going to be able to get the money they need, or the businesses, or to start businesses, what's the first thing they're going to look at? I can get that money for 5%. I can get that money for 2%. We've been anchored down next to zero since 2008. For the last 13, 14 years, we've been down next to zero. So, that being said, they can't raise the interest rates. If they raise the interest rates now, the banks aren't even paying you anything on your checking accounts. It's been at zero so long nobody expects it anymore. So they actually get your cash that you deposit is free for them to use. A lot of banks last few years have changed their savings accounts into money market accounts. Because now they can take that. If it was just a regular savings account, they only had 2 or 3 things they could do with it. They changed their banking rules, and so they changed it over to a money market account so that they can actually take and get a return about 5 basis points at the reverse repo market overnight on money that they're not even paying you to park at their bank. So what happens if the Federal Reserve raises those rates? Well, then the bank goes, I'm not paying anybody for this money. And all I got to do is take it. The Federal Reserve is now paying 5% instead of 0.05% on that money. Well, now we'll just keep the bigger portion. We'll park our money over here with the Federal Reserve in repo or reverse repo. We'll get our 5% return, and we didn't have nothing put into it. So that would actually be more inflationary than the way it previously was. So the one tool that the Federal Reserve, Jay Powell and the guys at the Federal Reserve actually think they have, they don't have. And mind you, we started getting inflation in 71, 72. They started calling it transitory. In 74, they admitted they might actually have a problem. It took them to 1981. They had to raise rates all the way to 21% just to break the back of inflation. If that genie gets completely out of the bottle again and we can't raise interest rates because that's just as inflationary as keeping them at zero, or more inflationary than keeping them at zero, we have no tools to put that inflationary genie back in the bottle. And mind you, anybody watches Disney, if you release Jafar from that lamp, I'm sorry, you don't want him out of that lamp, and you don't want the inflation genie out of her lamp either. They're just as destructive. So, this is how money is created. This is actually a little lesson on interest rates. And hopefully the Federal Reserve, they have a history of being behind the curve. Hopefully they will get in front of the curve before it gets too late. So if you'd like to have more videos on how money is created, on how different things that the Federal Reserve is doing and things in financial news, just hit that subscribe button and come back to the channel.